Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are talking about diversification, not as a financial rule you memorize, but as a real-world principle that quietly protects wealth, stabilizes progress, and allows people to stay invested without constantly second-guessing themselves. Most people hear the word diversification and immediately think of spreading money across many investments. That description is not wrong, but it is incomplete. Diversification is not about owning more things. It is about reducing the chance that one mistake, one event, or one unexpected shift can undo years of effort. To understand diversification properly, it helps to first understand why people struggle without it. Human beings naturally like certainty. We want to believe that if we choose the right stock, the right sector, or the right idea, everything will work out. This desire for simplicity often leads people to concentrate too much in one place, especially when something has performed well recently. What experience teaches, often the hard way, is that success rarely breaks because of one dramatic collapse. It breaks because exposure was too narrow. When all progress depends on one outcome, pressure increases. Decisions become emotional. Small changes feel threatening. Diversification exists to reduce that pressure. At its core, diversification is not about maximizing returns. It is about making returns survivable. Wealth is not built by the best year. It is built by staying invested through many average, good, and difficult years without being forced out at the wrong time. One of the biggest misunderstandings about diversification is the belief that it lowers returns. In reality, diversification lowers volatility, which improves behavior. Better behavior often leads to better long-term outcomes than higher theoretical returns that people cannot emotionally tolerate. People often abandon good investments not because the investments failed, but because the stress became too high. Diversification lowers stress by ensuring that no single outcome controls your entire financial future. A simple way to think about diversification is to imagine how life actually unfolds. Different parts of the economy perform well at different times. Industries rise and fall. Countries grow at different speeds. Interest rates change. Inflation appears and fades. No single asset benefits from all conditions at once. Diversification acknowledges uncertainty instead of fighting it. Instead of trying to predict which asset will win next, it accepts that multiple outcomes are possible and prepares for that reality. One common mistake is diversifying only on the surface. People buy several stocks but all in the same industry. Or they invest in different funds that are actually driven by the same underlying forces. True diversification considers how assets behave during stress, not just how many names appear in a portfolio. Another observed pattern is emotional diversification. When people are too concentrated, they check prices constantly. Every headline feels personal. Diversification reduces the emotional intensity of market movements. When one asset struggles, another may stabilize the experience. This balance makes patience possible. Diversification also protects against overconfidence. Concentrated success often feels like skill, even when it is partly luck or timing. Diversification introduces humility. It reminds investors that uncertainty always exists, even when things are going well. Experienced investors understand that diversification is not about avoiding loss entirely. Loss is part of investing. Diversification is about avoiding permanent damage. Temporary declines are survivable. Permanent loss of capital or forced selling is not. Another practical insight is that diversification works best when paired with time. Over short periods, diversified portfolios may feel slow or unimpressive. Over long periods, they tend to deliver steadier progress. The goal is not excitement. The goal is endurance. Many people confuse diversification with indecision. In reality, diversification is a deliberate choice to reduce dependency on being right. It removes the need for perfect timing. It reduces regret. It creates a system that continues working even when individual decisions are imperfect. Diversification also interacts strongly with compounding. Compounding requires staying invested. Staying invested requires emotional stability. Diversification supports that stability by smoothing the journey, even if it slightly reduces peak outcomes. Another real-world mistake is constantly changing diversification based on recent performance. Chasing what just worked defeats the purpose. Diversification works when it is maintained through cycles, not adjusted emotionally in response to headlines. People who benefit most from diversification often describe their strategy as boring. That boredom is protective. It prevents overtrading, panic selling, and constant restructuring. Boring strategies often outperform exciting ones simply because they are easier to stick with. It is also important to understand that diversification evolves with life stages. Early investors may tolerate more concentration. Later investors often prioritize stability. Diversification is not fixed. It adapts to goals, timelines, and responsibilities. Another overlooked benefit is decision clarity. When a portfolio is diversified, individual decisions carry less weight. This reduces fear of mistakes. Mistakes become manageable instead of catastrophic. Learning becomes possible without trauma. Diversification also allows investors to remain curious rather than defensive. Instead of protecting one idea at all costs, diversified investors can observe markets more calmly. They adjust thoughtfully rather than react emotionally. In practical terms, diversification can include asset classes, geographies, industries, strategies, and even income sources. The goal is not complexity. The goal is resilience. Each layer reduces dependence on a single outcome. A powerful way to judge diversification is to ask one simple question. If this one thing goes wrong, does my entire plan break? If the answer is yes, diversification may be insufficient. Over time, people who build wealth tend to care less about winning big and more about not losing badly. Diversification aligns perfectly with that mindset. It prioritizes staying in the game over trying to dominate it. The greatest strength of diversification is not mathematical. It is psychological. It allows people to remain patient, disciplined, and consistent, even when markets are uncomfortable. When diversification is understood properly, investing stops feeling like a test of intelligence and starts feeling like a system of risk management. That shift changes everything. Ultimately, diversification is an admission of reality. The future is uncertain. Markets are complex. No one is right all the time. Accepting this truth and building around it is not weakness. It is wisdom. If this explanation helped you see diversification more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.